I know you've got a 3 Sharpe ratio strategy.
It's 3.64, actually. But only to 6 figures. Any bigger than that and it won't work.
Figure out how to get it big enough to cut me in, or I'll cut you.
Like, with a knife? Are you threatening to...
No. But I'll flip you. I'll flip you for real.
How much do you guys love this Winston guy, who is not only extremely annoying, but this season they decided to give him an annoying little mustache. A little porn stash, it's gross. And of course, he's from Taylor's team. I liked what Dollar Bill was saying about the cutting and the flipping, but what would be even better is him taking that little mustache and ripping it off. That's a scene that would really get me to love Billions again. But anyway, this was an interesting conversation going over Sharpe ratios and how much money a strategy can handle. So that's what we're gonna break down in this video, and by the end, you'll see how you can apply these same concepts to your own market strategy. And speaking of strategies, I finally put together a training that explains exactly how I trade the market. It's a free training. There's a link down below in the description and comments and at the top of this video. Go here and sign up and you'll see the training where I explain exactly what I do and how you can do it too. And you guys know I spend very little time actually investing in the market because my process is really streamlined. Zero research. That's the way I like it. But with that low time commitment, I still get solid profits. You can learn all about it in this free training. Okay, so the Sharpe ratio, what is it? All it is a financial equation that we can use in a standardized way to compare different portfolios and different strategies. And basically what it tells you is how much return you're getting, like how many profits, compared to how much risk you're taking in the market. Because your goal in the stock market when you're investing in really any type of market is to reduce your risk as much as possible and increase your profit potential as much as possible too. But we also know that higher risk also usually means higher rewards. But it is possible to have low risk, high reward. And that's what the Sharpe ratio helps you measure. So that's why Dollar Bill went to the little mustache boy and he was like, hey, whoa, your Sharpe ratio is a 3.0 for this strategy, let me in. And then the little boy was like, actually, it's a 3.6 because he's annoying like that. But that's a standardized measure where Dollar Bill, even not having any idea what the strategy was, he knew it was good. Because as we'll discuss in a second, like a 3.0 or a 3.6, that's an incredible Sharpe ratio for a strategy that you will likely only see in TV shows. So the actual formula to calculate the Sharpe ratio of your strategy is this right here. So it's the return of your portfolio or your strategy minus the risk-free rate divided by the standard deviation of the portfolio's returns. So let's break down each variable. So the RP, the return of your portfolio, that's pretty standard. It can be like how much did your strategy make last year? And that's easy to calculate, right? If you start with $100 and you end up with $110, that's a 10% return. So you would put that 10 where this RP is. And then the risk-free rate is the going rate for, say, a treasury bond. So if you invest in a treasury bond, it's considered risk-free because it's backed by the US government. Now, is it actually risk-free? No, but you gotta get these numbers from somewhere, right? So that's what the industry uses. So say treasury bonds are yielding 5%. So then you would put a 5 right here. So what are you actually getting here by taking your return and subtracting the risk-free rate? You're getting how much profit you made above what you could have gotten by putting it into treasuries where there was no risk. So it's almost like calculating alpha. How much money are you actually pulling out of the market above what you could just get for free with zero risk by just investing in bonds? So if we said we got a 10% return and bonds were returning 5%, then 10 minus 5 is 5, right? So we're doing 5% better than bonds. That's like the alpha that we created. So what return is coming from my actual skill as a portfolio manager? 5%. Then you take that and you divide it by the volatility of that portfolio. So to get that extra 5%, right, the returns above the risk-free rate, how much volatility did the portfolio have to go through? So say you calculated that for your portfolio and you saw that the number was 5 again. So what do you end up getting? 5 divided by 5 equals 1, and that would be your Sharpe ratio, a 1. So a Sharpe ratio of 1 is considered acceptable and like good. A Sharpe ratio of 2 is very good, and a Sharpe ratio of 3 is just like incredible. So 3.6, what they were talking about in the show, is like amazing. And then if you have a Sharpe ratio of anything under 1, then it's considered not that good. So there's a few ways you could get a ratio under 1. So for example, if your return of your portfolio was only 4 and the risk-free rate was still 5, then you'd get a -1, right? And then divide that by whatever, and it's still negative. You don't even need to divide it to know that you're not making more money than the risk-free rate. So why would anyone go with that portfolio? Or another thing that can happen is, say your return of your portfolio is still 10 minus the 5 we originally had. So this thing is 5 up here, but then the volatility volatility that you took to get that extra 5% return is 10. So 5 divided by 10 is what? 0.5. 0.5 is less than 1, which means it's not a very good strategy. And what that means is that you took on way too much volatility to get that small percentage return. It's not worth it. And this is an important number that allocators look at, like pension funds. So you've seen in Billions multiple times, even this same episode, Axe is always trying to schmooze clients because he needs people to invest in his hedge fund. So one of the first things they're going to ask or want to know is like, what's the Sharpe ratio? Because consider a pension fund, say for teachers, or even in this show, I think it was the pension fund for firefighters a few seasons ago. They need to grow all that retirement money of their people, but at the same time, they can't lose it. So they're going to want a strategy that has a higher Sharpe ratio because there's going to be less risk involved and they're going to get a steady rate of return because they want to beat inflation and grow. But even more important than that is not losing the money that they had in the first place because it's people's retirements, their life savings. Now, there are some problems with the Sharpe ratio though. One of them is that it assumes a normal distribution in the market, which isn't true at all. So normal distribution would imply that the market distributes a similar amount of winners and a similar amount of losers. But really, the market doesn't work like that at all. If it did, then you wouldn't get these huge crashes that happen every 10 years or so, because those crashes are tail events. And they call it a tail event because they're talking in terms of a normal distribution. So in a normal distribution, you have the most events occurring in the middle. And then the tail event happens on the sides, either a really big winner or a really big loser. So if you understand the structure of markets and the best investors in the game, you know they're always going for those tail events because that's where all the money is made. So if that's the case, then the volatility distribution that the Sharpe ratio measures isn't correct. So for example, say a certain portfolio is just selling options. Say they sell way out of the money puts. So when they sell those put options, they're collecting a premium, right? And this strategy might work great for years. Collecting a small premium, very low volatility, the Sharpe ratio would look great. But then every 10 years, you might get that huge crash. So prices blow through that put level and the strategy completely blows up. So in that case, the Sharpe ratio really didn't do anything, right? Because the strategy turned out to be a lot riskier than you thought it was by just looking at that one number. And again, that's the tail event the Sharpe ratio isn't taking into account. So like with anything, including the Sharpe ratio, you need to use it within the context of other factors as well. Like you can't just judge a strategy based off this one number. You need to understand how it works too. Because even going back to this, what if this number on top is 100 and then the volatility is 50? So the Sharpe ratio is 2, but still that strategy may be way more volatile than you want. A pension fund would never go with something like that. Another problem with this equation is that it treats all volatility as bad volatility. So here's the thing about volatility. It's measured the same way on the upside and the downside. So good volatility is when the stock that you picked is taking off. Bad volatility would be it dropping way too fast. But in this equation, it counts both of those as the same, which when you're trying to evaluate a strategy, you don't want that upward movement to be counted against it, right? Because that's what makes you money, especially if we know the market isn't normally distributed and most of the money is made on those tail events, then you want those good tail events to count towards a better number in the equation. Well, that's why we got something called the Sortino ratio. So it's like an upgraded version of the Sharpe ratio, and it makes a lot more sense because what it does is remove the effects of the upward price movements on the standard deviation. And instead it focuses on the distribution of returns below the target or required return. So all that's saying is that this standard deviation, the denominator of this equation, it basically gets lowered. It becomes a smaller number because of the actual positive side of the volatility is taken out. So now this is only negative volatility, which is really what you want to be avoiding. Positive volatility works for you. So by doing that, you get a much better reading of what the strategy is actually doing. So in my case, with this strategy that I was talking about in this training, which again, link down below in the description and comments, well, that strategy has a Sharpe ratio of 1.1, which is good, but we focus on the Sortino ratio. And for the Sortino ratio, the strategy comes in at 2, which is very, very good. And the reason why there's such a big difference is because that strategy focuses on finding stocks that are moving higher the fastest. So it's benefiting off the volatility to the upside. And then it has really good risk control, so it cuts that downside. But with the Sharpe ratio, it's measuring both the downside and the upside the same, which it shouldn't be, because we purposely cut off downside volatility and let the upside volatility go, because that's what makes us money. So that's why the Sortino is a much better measurement of what's happening in that strategy. And you'll see more about what I'm talking about in that training. Now, the next thing that they talked about in that scene was how the strategy couldn't handle too much money, only below 6 figures. So this is something that we've talked about in previous Billions videos, where certain strategies only work with certain amounts of money. So you remember this episode from last season with Axe and the kid that he funded because his dad died in 9/11. I think he was part of Axe's firm. Well, he grew up, became a hedge fund manager, and then he told Axe, hey, you can take your investment back. I don't want want your investment in my fund anymore. Axe was mad, and then they go on a boat. Axe eventually screws him, but they also had that conversation where this younger guy was like, hey, I want to stay below $1 billion because I don't know if I can manage $1 billion. And Axe is like, oh, you just got to do it. Eye of the tiger. But what we explained in that video is that things change as you get to each level. So for example, you don't see any hedge funds in penny stocks. And the reason why is first because penny stocks are mostly scams, and then also they have way too much money. They can't invest in these tiny little vehicles. So even if someone was making 1,000% a year in penny stocks, that same strategy wouldn't work for a hedge fund. Otherwise, every hedge fund would just be in penny stocks. Even Warren Buffett, he says he would make much better returns if he had less money. Because again, when you get to a certain level, there's only some strategies that can handle that much money. There's only some markets that are big enough. And normally when you get to that level of billions and billions of dollars, the returns are lower, which is why it's so impressive to see a guy managing 10 billion making huge returns, because it's so much harder than if you had less money. So as I mentioned before, that Sharpe ratio of that porn star kid strategy, it was a 3.6. That's incredible, right? So it makes sense that there's some type of restraint. It seems to be a strategy that only works with smaller amounts of money. So there could be a few reasons for that. One of them could be the same issue that you face with penny stocks. Too much capital going into these investments that are more illiquid. So whatever strategy he was pulling, that could be why he didn't accept dollar bills money. Or it could be when there's too much money, you end up having to take more trades than you would have. So say you're running your strategy and you get 5 potential trades, and normally you only want to take the top 2 because those give you the best returns. Well, if you have too much money that you're trying to pile into these top 2, you can't. So then you start taking the 3rd, 4th, and 5th, which give lesser returns, or maybe they're more volatile. And either way, a worse return would affect this number, and more volatility would affect this number. So your Sharpe ratio would be all screwed up, and the strategy wouldn't perform the same way. So there are limitations. Now, what I like about my strategy is that it works with small accounts and large accounts. And that's because the strategy is based off investing in very liquid stocks. It's not trying to take advantage of tiny penny stocks that can be manipulated. So it's the same strategy that multiple funds, RIAs, and family offices are using right now, but it's also very effective for small accounts. So it's nice because as your money grows, the strategy keeps up. It's not going to fail on you when you reach a certain level. Well, if you had billions of dollars, then yeah, the strategy is not going to work as well. But most people aren't there yet. Anyway, if you want to learn more, just sign up for that training. Link in this video and down below in the description and comments. They'll go into depth about this strategy that I'm using and how you can use it too. And if you like this video, make sure you subscribe. I should be making some more billions videos. We'll see how it goes. But subscribe so you don't miss them. And I will see you in the next one. Stay fallible out there. Bye.